July 1944, Mount Washington Hotel, Bretton Woods, New Hampshire. Representatives from 44 nations gathered to rebuild the global monetary system. World War II was still raging, but the victors were already planning what came next. John Maynard Keynes, representing Britain, proposed the Bancor, a supranational currency for international trade. Neutral, fair, no single nation would dominate. The Americans rejected it. The US dollar would be the world's reserve currency, backed by gold at $35 per ounce. Every other currency would peg to the dollar. The dollar was the system. Britain, financially exhausted and increasingly dependent on US support, had little leverage to push an alternative. The pound sterling, which had dominated global finance for over a century, was being replaced. The transition was official, diplomatic, negotiated, and irreversible. But it marked the end of British financial dominance and the beginning of the American century. This wasn't the first time a reserve currency lost its status, and it wouldn't be the last. Before the pound, there was the Dutch guilder. Before that, the Spanish real. France tried and failed with revolutionary assignat. Each lost dominance. Each fell for different reasons, and each was replaced by the next rising power. This is the story of how 4 reserve currencies lost their dominance, not because of one pattern, not through predictable stages, but through 4 completely different paths that all led to the same destination: replacement. What is a reserve currency? It's the money that central banks, governments, and international traders hold and use for transactions. It's the currency you need to participate in global trade. If you're selling oil, buying wheat, or settling debts across borders, you use the reserve currency. Reserve currency here means the dominant currency for international settlement and safe asset storage in its era, an imperfect comparison to today's modern central bank reserve system. To become one, a currency needs 4 things. First, a large and stable economy. Other nations need to trust that the currency will hold value over time. Inflation, political instability, or economic collapse destroys that trust instantly. Second, deep and liquid financial markets. Foreigners must be able to buy and sell assets denominated in that currency easily: government bonds, corporate debt, real estate. If markets are thin or restricted, the currency can't function globally. Third, military and geopolitical power. Reserve currencies don't exist in a vacuum. They tend to be supported by the ability to protect trade routes, enforce contracts, and project power when necessary. Fourth, and most importantly, trust. Trust that the issuing government won't debase the currency. Trust that contracts will be honored. Trust that the system is stable. Once trust breaks, dominance ends. In earlier centuries, this looked less like modern central bank reserves and more like the dominant settlement currency held by merchants, banks, and governments. The benefits of reserve currency status are enormous. The issuing country can borrow in its own currency at lower interest rates than anyone else. It can run trade deficits without immediate consequences because foreign holders need its currency for transactions. It can run deficits more easily because global demand for its currency absorbs issuance that might otherwise create immediate domestic inflationary pressure. Economists call this exorbitant privilege, but privilege is fragile. 4 currencies achieved it over the past 500 years. 4 currencies lost it. Here's how. The Dutch guilder became the world's first modern reserve currency in the 1600s. In 1609, Amsterdam established the Bank of Amsterdam, the Wissel Bank. Its purpose was simple: solve the currency crisis plaguing European trade. At the time, hundreds of different coins circulated across Europe, each with varying silver content. Merchants didn't know what their money was worth. Trade was chaotic. The Bank of Amsterdam created the bank guilder, a unit of account backed by silver deposits. When merchants deposited coins, the bank assayed the silver content and credited their accounts in standardized bank guilders. The bank guilder became the most trusted currency in Europe because its value was guaranteed. Amsterdam's location helped. The city controlled key trade routes. The Dutch East India Company, founded in 1602, dominated global commerce from Asia to the Americas. By the mid-1600s, Amsterdam was the world's financial center. Merchants from across Europe held accounts at the Bank of Amsterdam. At its peak in the late 1600s and early 1700s, the Dutch guilder accounted for a substantial portion of all international transactions. Foreign governments and merchants kept reserves in bank guilders. Bills of exchange were settled in guilders. It was the currency of global trade. The Dutch economy thrived. With a population of only 1 to 2 million, the Netherlands became one of Europe's wealthiest nations. Income per capita was double that of most European powers. Amsterdam's financial markets were the deepest and most liquid in the world. But the system had a vulnerability. The Bank of Amsterdam's credibility rested on the belief that deposits could be redeemed on demand. Over time, political lending and opaque credits weakened that foundation. As long as withdrawals were manageable, the system worked. But if too many depositors demanded their silver at once, the bank would fail. For over 170 years, the bank maintained credibility. Then came the Fourth Anglo-Dutch War. In 1780, Britain declared war on the Netherlands. The Dutch Republic had grown wealthy through trade, but militarily it had declined. The war went badly. Dutch shipping was devastated. The economy contracted. And the Bank of Amsterdam made a fatal mistake. To support the war effort and bail out the failing Dutch East India Company, the bank made massive loans. By 1781, the bank had lent over 10 million guilders to the company and extended huge credits to the government. These were bad loans. The Dutch East India Company, once the most profitable corporation in history, was collapsing. Its trade routes were disrupted. Its revenues had fallen. It couldn't repay. Depositors started withdrawing silver. By 1783, the bank's reserve ratio is estimated to have fallen from near full backing to roughly 1/3. There wasn't enough silver to meet redemptions. Word spread. More depositors demanded their money. The bank could no longer meet redemption demands at scale. In 1791, the Bank of Amsterdam attempted to stabilize by allowing limited withdrawals at below-market rates. Within 2 weeks, 344,000 bank guilders were withdrawn. Then it raised the withdrawal rate slightly. 1.6 million guilders left in 2 weeks. The run accelerated. By early 1791, the bank's credibility was destroyed. Foreign holders of guilders sold them for British pounds. The guilder collapsed. Amsterdam's status as the world's financial center ended. London replaced it. The British pound, already rising due to Britain's industrial revolution and naval dominance, became the dominant reserve currency by the early 1800s. The Dutch guilder's fall was rapid and catastrophic. War costs, bad loans, and a bank run destroyed a currency that had dominated global finance for over a century. The Dutch economy stagnated for decades. The Netherlands would never again be a global financial power. The guilder survived as a national currency until 2002, when the Netherlands adopted the euro. But its days as a reserve currency ended in the 1780s. While the Dutch guilder rose and fell in under 2 centuries, the Spanish real's decline took much longer and was caused by something completely different. Spain discovered the New World in 1492. Within decades, Spanish conquistadors had destroyed the Aztec and Inca empires and seized control of vast silver deposits in what is now Mexico, Peru, and Bolivia. The silver mines of Potosi, discovered in 1545 in modern-day Bolivia, became the most valuable resource in the world. At its peak, Potosi alone produced massive quantities of silver. Between 1500 and 1800, Spain extracted what is often estimated at roughly 150,000 tons of silver from the Americas. The treasure fleets, convoys of ships carrying gold and silver, sailed from the New World to Seville. Spain became the richest nation in Europe. The Spanish real, backed by seemingly endless silver, became the currency of European trade. Spanish silver flowed across the globe. It financed Spain's wars in Europe. It funded Spain's Habsburg monarchy. It paid for imports from across the continent. The real was everywhere. But Spain made a critical mistake. Instead of investing the silver in productive industries, Spain spent it. The monarchy waged constant wars against France, against the Netherlands, against England. The Spanish court was extravagant. Taxes on the lower classes were crippling, but the nobility and clergy were mostly exempt. And then the silver started causing problems. Between 1520 and 1650, Spain experienced what historians call the price revolution. Prices rose roughly sixfold over 150 years. That's about 1.2% annual inflation, mild by modern standards, but devastating in a pre-industrial economy where wages and productivity were relatively fixed. The influx of silver increased the money supply. More money chasing the same amount of goods meant higher prices. Spain's domestic industries couldn't compete. Why produce goods when you could import them with silver? Spanish manufacturing collapsed. The wool industry, once thriving, declined. Silk production fell. By the 1600s, Spain was importing nearly everything: textiles from France, weapons from Germany, grain from Northern Europe. Spanish silver enriched everyone except Spain. The Genoese bankers who lent to the Spanish crown profited. They engineered interest rate swaps and traded silver for gold to pay Spanish troops fighting in the Netherlands. The Dutch and English built their merchant fleets and industries, while Spain spent its wealth on war and imports. By the late 1500s, treasure fleet shipments started to disappoint. The most accessible silver had been mined. Output began declining. But Spain's debts kept growing. In 1557, Spain declared its first sovereign bankruptcy. It restructured high-interest short-term debt. Then it went bankrupt again in 1575, and again in 1596, and 1607, and 1627, and 1647. Inflation, driven by massive silver inflows, hollowed out domestic industry and amplified existing structural weaknesses. Prices were so high and unpredictable that people left cities and returned to subsistence farming. You couldn't plan. You couldn't invest. Money lost purchasing power faster than wages and production could adjust. Spain failed to develop a broad industrial middle class comparable to Northern Europe. It never industrialized. While England, France, and the Netherlands built factories, Spain remained dependent on silver imports that were dwindling. By the 1700s, Spain had gone from Europe's dominant power to a backwater. It lost the Spanish Netherlands. It lost Portugal. Its empire in the Americas began to fracture, and the Spanish real's status as a reserve currency quietly ended as trade shifted to Amsterdam and London. Spain's decline is often cited as an early example of the resource curse, where easy wealth discourages productive investment. Enormous wealth from natural resources, silver, prevented economic diversification and created dependency. When the resource flow slowed, the economy had nothing to fall back on. The real didn't collapse overnight like the guilder. It decayed over 2 centuries. But the result was the same: a once dominant currency replaced by the next rising power. France's experience with reserve currency status is the strangest of the four. It never truly achieved it, but it tried, and the attempt destroyed the French economy. In 1789, France faced a fiscal crisis. The monarchy was deeply in debt from years of war, including support for the American Revolution. The treasury was empty. Taxes couldn't cover spending. Bankruptcy seemed inevitable. The newly formed National Assembly had an idea. The Catholic Church owned vast properties across France, roughly a third of all land. The Assembly seized those lands and proposed to sell them to pay off the national debt. But there was a problem. France needed cash immediately, and selling land takes time. So in December 1789, the Assembly created a new currency, the assignat. Assignats were paper notes, initially issued as bonds paying 5% interest, backed by the value of confiscated church lands. Holders could use assignat to purchase church property at auction. The plan was straightforward: issue assignat, sell land, redeem assignat, and cancel the debt. The first issue in April 1790 was 400 million livres. It worked. Economic activity picked up. The currency held value. But the National Assembly, facing war and revolution, needed more money. In September 1790, it issued another 800 million livres in assignat, this time without interest. Assignat became legal tender, ordinary paper money. By the end of 1791, 1.5 billion assignats were circulating. Purchasing power had declined 14%. Then the wars began. France was at war with Austria, Prussia, Britain, Spain, nearly every major European power. The revolutionary government needed to fund armies, supply troops, and pay for internal programs. The printing presses ran constantly. By August 1793, nearly 4.1 billion assignats were in circulation. The currency had lost 60% of its value. By June 1794, 8 billion assignats existed. By the end of 1794, 7 billion were still circulating, despite government efforts to destroy notes when they were redeemed for land. The National Assembly, desperate to control prices, passed the Law of the Maximum in 1793. It fixed prices for essential goods and punished merchants who charged more. But price controls don't work when the currency is collapsing. Shortages spread. People hoarded goods. Black markets flourished. The value of the assignat fell from 31% of its face value in August 1794 to 24% in November, 17% in February 1795, and 8% by April 1795. By the end of May 1795, circulation had increased to 10 billion assignats. By July, 14 billion. By 1796, the total reached 45.5 billion. The assignat was worthless. People used it as wallpaper. Farmers refused to accept it. Merchants demanded payment in gold or silver, which had been banned. The working class, holding billions of worthless assignats, was ruined. In December 1795, the government stopped printing assignats. In February 1796, the printing plates were destroyed in a public ceremony in Paris. The government tried to issue a replacement currency, the mandat, backed by gold. It failed immediately. Trust in French paper money was gone. By May 1797, both the assignat and the mandat were worthless. Napoleon Bonaparte, rising to power as first consul in 1801, restored hard money. He introduced the 20-franc gold piece and insisted that soldiers, contractors, and merchants be paid only in gold. The assignat experiment was over. France's hyperinflation destroyed wealth, created shortages, and intensified social instability, conditions that fueled radicalization during the Revolution. It took nearly 40 years for French capital, industry, and commerce to recover to 1789 levels. The assignat never functioned as a reserve currency. It was a revolutionary government's attempt to print its way out of debt. It collapsed because political priorities, funding the revolution, waging war, and maintaining internal order, overrode economic constraints. But the lesson is clear. Trust in currency is fragile. Political pressure to print money destroys that trust faster than anything else. And once trust is gone, it takes generations to rebuild. The British pound story is different. It didn't collapse. It didn't hyperinflate. It was gradually, deliberately replaced by a more powerful currency, the US dollar. In 1815, Britain defeated Napoleon at Waterloo. For the next century, the pound sterling dominated global finance, like no currency before or since. Britain had the largest economy in the world. It had the Royal Navy, which controlled the seas. It had the gold standard, which guaranteed the pound's value at 1 pound equals $4.87 from 1880 to 1914. It had the British Empire, spanning a quarter of the globe. By 1914, the pound accounted for a dominant share of all foreign-denominated debt. Central banks and monetary authorities held sterling assets as reserves. International trade was conducted in pounds. London was the world's financial center. Then came World War I. The war cost Britain a quarter of its national wealth. By 1918, Britain had borrowed heavily from the United States. The U.S., which entered the war late, emerged as the world's largest creditor. Britain emerged as the world's largest debtor. In 1925, Britain returned to the gold standard at the pre-war rate of $4.86 per pound. Winston Churchill, then Chancellor of the Exchequer, believed restoring the pre-war parity would restore Britain's financial credibility. It was a disaster. The pound was overvalued. British exports became uncompetitive. Unemployment soared. The economy stagnated. In 1931, Britain abandoned the gold standard. The pound was devalued. Trust in sterling was shaken. Then came World War II. Britain fought from 1939 to 1945. The cost was catastrophic. Britain's national debt reached 250% of GDP. The U.S. again lent money, and this time there was no question who held the power. At Bretton Woods in 1944, the U.S., as the dominant creditor and industrial power, largely set the terms. The dollar, not the pound, would be the world's reserve currency. Other currencies would peg to the dollar. The dollar would be convertible to gold at $35 per ounce. Britain's John Maynard Keynes protested. He proposed the Bancor. He warned that tying the global system to one national currency, the dollar, would create imbalances. He was ignored. The pound initially remained a reserve currency alongside the dollar, but only because of artificial support. Britain maintained exchange controls and sterling area arrangements, requiring Commonwealth nations to hold sterling. Some scholars later described late-period sterling as zombie-like, sustained through controls and diplomatic arrangements rather than open market preference. In countries outside British influence, the dollar was the only reserve currency. Sterling's role was an illusion maintained by the remnants of empire. By 1949, Britain was in crisis again. It devalued the pound from $4.03 to $2.80, a 30% devaluation. The economic strain of maintaining the pound's value while rebuilding from war was unsustainable. Throughout the 1950s and 1960s, Britain struggled. Trade deficits persisted. The pound faced repeated speculative attacks. The Bank of England intervened constantly, selling dollars to buy pounds and defend the exchange rate. By 1966 to 67, Britain was borrowing from other central banks and the IMF to cover its deficits. It wasn't enough. On November 18, 1967, Prime Minister Harold Wilson announced a 14.3% devaluation, cutting the pound from $2.80 to $2.40. In a televised address, Wilson famously said, "The pound in your pocket has not been devalued," a statement mocked ever since. The devaluation was humiliating. It marked the end of any pretense that Britain could maintain the pound's global role. In 1971, the Bretton Woods system collapsed when President Nixon ended dollar convertibility to gold. Currencies floated, the pound fell further, hitting historic lows. By the 1970s, the pound's role as a reserve currency was over. Central banks held dollars. International trade was conducted in dollars. London remained a financial center, but the pound was just another currency. Today, the pound accounts for about 5% of global reserves. The dollar accounts for over 60%. Britain's decline was gradual. It took 2 world wars, decolonization, and the rise of American economic dominance. But the result was the same: replacement. 4 currencies, 4 completely different paths to losing dominance. The Dutch guilder fell because of war costs and a catastrophic bank run. The Bank of Amsterdam, which had maintained credibility for 170 years, made bad loans to the Dutch East India Company and couldn't meet withdrawal demands. Trust vanished. The currency collapsed in less than a decade. The Spanish real declined because of a resource curse. Massive silver inflows caused inflation, destroyed domestic industries, and prevented Spain from modernizing. The wealth that should have built Spanish power instead made Spain dependent and backward. The decline took 2 centuries, but it was irreversible. The French assignat hyperinflated because revolutionary ideology prioritized political goals over economic stability. The government needed money to fund wars, programs, and the revolution itself. It printed 45 billion assignats, destroying all value in 7 years. Trust in French paper money didn't recover for decades. The British pound was displaced because 2 world wars bankrupted Britain and elevated the United States to global dominance. Britain went from the world's largest creditor to the world's largest debtor. The pound didn't collapse. It was replaced by the dollar through negotiated agreements at Bretton Woods. The transition took 40 years, but it was complete. There is no single script, no universal sequence every reserve currency follows. The Dutch fell fast through financial crisis. The Spanish declined slowly through economic decay. The French destroyed their currency through hyperinflation. The British were displaced by a rising power. But there are commonalities. First, trust is the foundation. All 4 currencies required trust to function as reserves. The Dutch lost trust when the bank couldn't redeem deposits. Spain lost trust when inflation made the real unpredictable. France lost trust when assignats became worthless. Britain lost trust when devaluations made the pound unreliable. Once trust breaks, replacement accelerates, sometimes quickly, sometimes over decades. Second, military and economic power matter. Reserve currencies are backed by strength. The Dutch lost wars and couldn't defend their trade routes. Spain's military power declined as its economy hollowed out. France's military victories under Napoleon came too late to save the assignat. Britain fought 2 world wars and emerged victorious, but bankrupted. Power shifts, currencies follow. Third, the issuing country's fiscal health determines the currency's stability. The Dutch overextended with war debt. Spain went bankrupt 6 times. France printed money to cover revolutionary spending. Britain borrowed unsustainable amounts to fight wars. Deficits and debt destroy reserve currencies when they become unmanageable. Fourth, every reserve currency was replaced by the next rising economic power. The Dutch guilder gave way to the British pound because Britain industrialized and built global trade networks. The Spanish real faded as Northern Europe developed manufacturing. The French assignat never threatened the pound because France's economy was unstable. The British pound was replaced by the dollar because the US became the world's largest economy and creditor. Dominance is temporary. Someone is always rising while someone else is falling. And fifth, the transition benefits the replacement currency. Britain's economy boomed as Amsterdam declined. Britain profited as Spain's silver enriched European merchants. The US emerged from both world wars wealthier and more powerful, while Britain declined. Reserve currency transitions are not neutral. The rising power gains at the expense of the declining one. What can history tell us about the present? The US dollar has been the world's dominant reserve currency since 1944, 80 years. It accounts for over 60% of global reserves, the majority of foreign exchange transactions involve the dollar on one side, and it dominates international debt issuance. The dollar's dominance rests on the same foundations the pound, guilder, and Spanish real once had: a large and productive economy, deep financial markets, military power, and trust. But history also shows that dominance doesn't last forever. The Dutch thought the guilder was unshakable. Spain believed its silver would last indefinitely. Britain assumed the pound's role was permanent. They were all wrong. The question isn't whether the dollar will eventually lose its dominance. The question is how and over what time frame. That doesn't imply imminent collapse, only that reserve status is not permanent. Loss of dominance can also mean partial erosion. multipolar reserves, not necessarily a single dramatic fall? Will it be sudden, like the Dutch guilder, collapsing from financial crisis or war? Will it be gradual decay, like the Spanish real, as the economy hollows out and competitiveness fades? Will it be ideological, like the French assignat, destroyed by printing to fund unsustainable spending? Or will it be displacement, like the British pound, replaced by a rising power through negotiation and shifting economic reality? History doesn't repeat, but it offers possibilities. The Dutch guilder, Spanish real, French assignat, and British pound all lost their dominance. Each followed a different path. Each was replaced by the next rising power. And each left lessons about what it takes to maintain reserve currency status and what happens when it's lost. Trust is fragile. Power shifts. And dominance, no matter how secure it seems, has always proven temporary.